Let's take a look at forward rate agreements. Now, this is an interbank contract that involves two parties, a buyer and a seller. And if you happen to be familiar with the concept of a swap, it's identical to a swap, except it's only for one settlement period. Now, there's something referred to as the notional amount, and this is the reference amount that the interest cost is based on, although the notional amount is never exchanged. What happens is the buyer agrees to pay the seller the increased cost on a notional amount if interest rates fall below an agreed rate. The seller agrees to pay the buyer the increased interest cost if interest rates increase above the agreed rate. So, what are some of the uses here? Well, a bank can use it to hedge interest rate risk. For example, say the bank has made 3-month euro-dollar loans against an offsetting 6-month euro-dollar deposit. It could protect itself by selling a 3-against-6 forward rate agreement. So in this case, if rates fall, the bank will receive less on new loans while paying the same on its deposits, but it's going to receive money from the forward rate agreement. So that's going to offset some of the loss. Okay, it could also be used to speculate on the future course of interest rates. All right, so let's take a look at what this stuff means. A 3-against-9 forward rate agreement is a 3-month forward contract on a 6-month interest rate for a 6-month period beginning 3 months from now. So if you look at this timeline here, right, we make the agreement here, but the cash isn't settled until month 3, and this is for this 6-month period interest rate. Okay, looking at it from a graphical point of view, we have the agreed upon rate, and we have this settlement rate, okay, the rate we have at the end of the settlement period. If they happen to be the same, then no money changes hands, right? If we set it at 2% and it's 2% for the settlement, then no money changes hands. However, if the interest rate, the settlement rate, is above this agreed upon rate, so if this were 2% and this were 3%, then the long position would receive a payout from the short position. Similarly, if the interest rate went down, let's say from 2% to 1%, the short position would receive money from the buyer of the position. So at the end of the agreement period, the loser pays the winner an amount equal to the present value of the difference between the settlement rate and the agreement rate, sized according to the length of the agreement period and the notional amount. Right, so this is the amount. This never changes hands, but this dictates how much interest is paid. Right, if you have a notional amount of $5 million, you're not going to pay out as much as if the notional amount were $10 million. So you look at the difference between these two rates. You have to adjust for the number of days, and then you take the present value of it. Let's take a look here at a numerical example. So you have a 5 million euro, 4%, 3-against-9 forward rate agreement entered into January 1st of 2018. So here's January 1st, 2018. The payment is made 3 months later on March 1st of 2018. And it's for this 184-day interest rate. Okay, 6-month rate. So, as we said before, if the actual rate is 4%, then no money changes hands. If on March 1st of 2018, the settlement rate is 5%, then the seller pays the buyer 24,918.74 euros. And you can work that out for yourself. This would be 0.05 minus 0.04 times 184 over 360, okay, divided by 1 plus 0.05 times 184 over 360, right? And if the interest rate goes down to 3%, the buyer pays the seller 25,169.62 euros. So the forward rate agreements are designed so the buyer will have the same future value of interest expense, okay, that is a perfect hedge at the agreed upon rate for any value of LIBOR at maturity of the forward rate agreement. So you can see here that if whether the interest rate went down to 3% or up to 5%, it always works out to be the same. Now this is the same equation we had before, but what we have is we don't see the denominator, the present value part, because you're not finding a present value. So, regardless of what happens, the cost is the same. 5,102,222.22 euros. So this is quite a nice hedge. Okay, very important for banks because they oftentimes have a mismatch between assets and liabilities, and changes in interest rates can be quite devastating financially. So hedging is a really valuable way, and the forward rate agreement is one useful way to do this.